here we're going to go through some bullet points of whole life insurance and really see how it works. So let's jump into it. With a whole life insurance policy, here is what I want to be aware of. A couple components I have. Firstly, I have a premium. Whatever that premium is, that is level for the whole life of the life insurance policy. Now, when I have a whole life policy, that does not mean that I have to pay premiums for my whole life. I can design a policy where I stop paying after 2 years, 5 years, maybe it's a certain age, I stop and go. I can design it to be very flexible. Then, or next, I have a death benefit, the actual life insurance component of a policy. There's a life insurance policy. Quick side note is that death benefit proceeds are always paid out 100% income tax-free. So when I die, whatever that total amount of life insurance is paid income tax-free to my beneficiaries. Then I've got the area that interests everyone. CV, short for cash value, which with a whole life insurance policy will go nowhere but up over time. So let's touch on the cash value. Some bullet points here because again, this is the topic of interest to everyone. A couple bullet points. First, there's no risk. And what that means really is that the funds themselves are in no way, shape, or form invested in or linked to the stock market. So the next question is, how do insurance companies actually pay me interest? Where do I generate a return on a policy? Because if I set it up properly, you may have seen content on this, that 4 to 6% range is something I can expect if it is set up properly. So, where those returns are generated, a couple things. I have a guaranteed floor, a guaranteed rate of 4%. In addition to that, a company will pay a surplus. The guarantee plus the surplus will equate to a total dividend rate. Dividends, especially with the top companies, you'll see range from about 5 to 6.4%, and this is for 2019. You will see dividends fluctuate a bit year to year. One important side note is that is always a gross return, and we've got content on gross versus net returns. A couple other important items. Contributions, meaning the money I pay into the policy, are always made with after-tax dollars. What that means is I cannot deduct the contribution like I can with a 401k. I cannot write it off against my income. More like a Roth account, payments I make are with after-tax dollars. The growth is technically tax deferred, so as it's growing, I do not pay taxes on it. And then I can access the money 100% tax-free if, I'm going to put that in caps, I do so properly. And the reason we mention that is often cash value life insurance is marketed as tax-free, tax-free, tax-free. Tax-free is a buzzword or buzz phrase that draws in a lot of interest. It does. If I do everything right, I set the policy up where I don't trigger a MEC, I don't let it lapse or cash out with a gain, different items. If I don't trigger those, it will remain tax-free. But I want to be made aware of those events that can result in a taxable event. This way I don't have to deal with taxes. So the big attraction to this is the tax-free feature. And if I set everything up properly, I'll have that. And then the last point, and this ties in really to IBC, and this has to do with the loan feature, is I've got a unique loan feature, and really how this works is once a dollar passes through the cash value of a life insurance policy, whether I just let it sit there and grow earning that 4 to 6%, or if I borrow some of it or all of it out, I continue to earn that same 4 to 6% on any money in cash and also what I've loaned out. So there's no lost opportunity cost. The money continues to stay at work for me. That is a higher level overview of how whole life insurance works.